Carr, founder and CEO of FinTech Day, a research firm focused on FinTech. I'm here with Vishal Garg, CEO and founder of Better. Thank you so much for joining me. Really appreciate it, man.
Thanks, Ian. It's great to see you again.
Yeah.
It's been a little bit of time.
I know. So for the audience, I interviewed at Vishal's company many years ago. So I know a little bit about Better and know Vishal. So really excited to, kind of talk about the company and his experience and, share that with you guys. So, Vishal, before we get started, why don't we talk a little bit about, before we talk about Better, why don't we talk about your professional background and, building such a successful company? What are some skills that you've developed that, kind of help set you up for success today?
Awesome. Well, I would say that I've been learning all my life. Mm-hmm. I think, the things that I learned, like trading baseball cards or then, running a bunch of small like businesses or, even my first big startup, My Rich Uncle, which was a student loan company that became public and like went public in 2005 and then, mm-hmm. got swept aside with the credit crisis. All of those things helped me learn about the way the financial services ecosystem works. So ton of learnings from like post the credit crisis when I was running around every bank trying to figure out how to help them fix their student loans, how to help them fix their mortgage books, how to help them like fix these CDOs. And so the first thing I learned is like most people who are doing things in very large companies move from being like goal oriented to being task oriented. Mm-hmm. And then in big silos, like things get dropped. So you have somebody doing like with lots of really great intentions, doing a task and thinking about doing it well, but they don't see how the bigger picture connects.
So it's not the biggest time the inputs towards the outcomes, I guess. And like
that's
maybe
right.
The inputs don't really just like you're not doing stuff for no reason, right?
Yeah. And so then the managers become the people who talk to the other parts of the company. And they're like then hoarding that power and knowledge about how like the dots connect to become managers. And then you have the people at the top trying to make really good decisions, but they're only seeing a really small piece of the pyramid. So like they're at the top of the pyramid, but they're like only seeing this piece rather than the big piece, right? And how all the pieces actually work. Yeah. So the number one thing I learned is to try to teach every single person in my company how everything they do tries to connect to the other things that they do, right? And so it's good for them to have their own personal KPIs and to have like their own like metrics that they measure themselves by. But it's way more empowering if they see how they fit into the whole chain, how they create this value for the consumer, how they create value for themselves, how they create value for their business partners, and how they create value for all of our shareholders, including themselves. And so I have taken an approach of being super transparent with my team. Like, we go through all the same things that we went through with our board at our quarterly board meetings with all 5,000 of our employees. We do a monthly town hall. We do all these things to try to get people to understand how things connect. And I think that was like my big key learning from being in all these different aspects of financial services that I've been in. And I think it's helped enable us to drive this massive growth that we've had. I was literally, meeting with our head of recruiting, and she joined in February. We were 1,200 people. Yeah. And today we're 5,500 people.
That's insane. I mean, that's insane if you think about that growth. So like, talking about the culture and talking about, the transparency and that aspect around, first of all, I love it because as someone who's worked in a lot of different companies, it's not something you see that often. Like, it's really difficult to understand, like, okay, this one product that I'm working on, like, how does that fit into the overall picture, right? You can have a good understanding if you are at a core product, but if you're at an ancillary product that like is just getting started, it's really kind of hard to understand that macro picture. How do you kind of sustain that as you add 3,000 people pretty much in like pretty much like what 6-8 months? Like how do you kind of maintain that culture, if that makes sense?
I think the one of the key things that we have to teach people. And I'm a Star Wars junkie, so like I remember like this scene in like the original Star Wars where like Luke is with Yoda in like Dagobah, and one of the thing and like Yoda raises the X-wing fighter from the swamp, and Luke Luke says, "I don't believe it," and he's like, and he said, and Yoda says like, "That is why you fail." And so like the number one thing.
I love Star Wars too. I know all the words.
All right. So and the second thing, you have to unlearn what you've learned. So people come to us from these big companies. We're like, we don't really care so much about your title. We don't really care so much about this thing. That one of our core values is you pass on what you've learned, right? And that's critical. And I think, it's almost like the inverse relationship. When you're growing really fast, the amount of time for bullshit and politics is much, much lower because everybody's looking to collaborate. Everybody's looking to like share work. Everybody's looking to, because like, wait, oh my God, like things are moving so fast. I need help. Yeah. Like everybody at Better starts like this year with, I need help. I need help. Right. Whereas like, and that like creates a culture of sharing. So when you have like big companies and they're growing 3% a year, you literally just can like just see a company that's growing 3% a year will have way more politics and way more like silos and way more of this than that. And honestly, that's our advantage. When people ask, like if you ask our CTO, Eric Bernhardtson, like who joined us from Spotify, he was like the guy who created like all the matching engine at Spotify that connects people to the music that they love. He will say, when we go talk to our banks and our bank partners, it's like, what is the core competitive advantage that we have versus the banks? It's speed. It's that we can be wrong faster.
Yeah.
We can be wrong 10 times in the space that it takes them to write a memo about something where they might be right.
Exactly.
And it's just like, that's the speed. That's our advantage. And how do you expand at speed? You have to like, you literally have to like say you will be rewarded for collaboration, and you will be you will be demerited for siloing.
No, I mean, I'm taking notes because it's really great stuff. Because I mean, like the fact that you can be wrong 10 times and your competitor can't even be wrong once in that span is the fact that you can learn 9 times and gain 9 different learnings from that process is really important. And I think it's something that when thinking about hiring teams and building teams, like that's actually probably the biggest advantage when you're thinking about competitors and incumbents in the space, right?
Yeah, and it's really hard because nowadays what happens is like in the old days, like when I like started my first company in the 90s, it was crazy to leave banking,
right?
Or or any like top tier like fancy job, like at a like whether it was like you're a journalist and you're leaving the Wall Street Journal, or like you're a banker or you're leaving Goldman Sachs. It was crazy. Nobody did it. So it was really for like the adventurous. It was like for the Buccaneers. Now it's like the thing to do. So when you interview as a manager and you're like as a founder, you're like, wait, is this person coming to work at a startup, or is this person coming for an adventure? Are they coming for startup, the Disney ride, where it's like Space Mountain you get on and like, you have some ups and downs, but like now you're going to be safe. Yeah. Or are you coming for like, to go to space, right?
Exactly.
Like,
it's hard when you work with incumbent and you hire from incumbent folks. Like, my co-founders from Bloomberg, and, I was, thinking about that. Like Bloomberg's a very established, traditional media publication. The startups are not that, smooth and sailing. There's always going to be bumpy rides. And I think that's something that I communicated pretty early on to like the people that I recruited from, traditional. I think recruiting startup people is actually a bit easier in some ways because they get it. They're kind of signing up for it and like they understand the process. Teaching the people from banking and traditional industries that like, hey, there might be one day where like literally nothing goes right, and like don't let that be discouraging. I think is really interesting, right?
Yeah. I used to have this great test because we'd have like these bank execs and stuff like that. And then, we would send them on their first trip and we would get them, we do JetBlue, not even premium economy, regular economy. Yeah. And then we'd find them the seat by the toilet. And then, like we can't do this right now, but like if you want to like vet a big company person, buy them a JetBlue seat by the toilet, right? Have the buy them that seat, not even, and then like see how they do, because like that's what you need. I guess there's probably different versions of that, right? But like we hired.
I heard a story about someone hiring someone and telling the waiter or the waitress before to be really rude and just see what happens. just to see how they interact, you know?
Yeah, totally. So, there's lots of little tests you can do to like see if people's really just down for the adventure or if they're down for like the Disney ride. And I think it gets tougher and tougher because, as you scale a company, you're not the person interviewing. And so I had another startup founder tell me like, hey, the most dangerous people in your company are not the people who are not doing well. They're not the C's. They're not the D's. They're not even the B's. The most dangerous people in your company are the A minuses. Because the A minuses, they're just good enough to get you what you need, but they're actually destroying your culture. Because A minuses never hire A's. Because A's know, like when A minuses hire B's or B pluses. And B pluses and B's, they hire C's. And soon you're swimming in a sea of C's. Yeah. And that's the killer. So at least when you hire somebody who's like, I want a 9 to 5 it and clock out and do my daily thing, and this is what I expect. Cool.
That's great. That's
awesome.
Lovely. Yeah.
Lovely.
I tell my brother's the same way. He's like, yeah, I'm just looking for a job. He's in medicine, right? So very different than us. Yeah, I'm just gonna go in and go out. It must be nice, because I've never really experienced that in my life, Yeah.
But like, that's great. You know exactly what those people want and like what they need. The worst is someone who's like, yeah, I want it. But they're like, yeah, I'm sorry, and then you're just like, wait, if you're not doing this job, I'm doing this job.
Yeah.
And dude, like the machine's got to keep running. Like we are on the internet. This is a 24/7 business. That's the whole competitive advantage. We are on the internet. It's open all the time. Right?
That's the beauty of it, right? It's only, we run a publication, right? There's no printing press I have to worry about. I just hit publish. Yeah. We talked a lot about, our philosophy around company building, but let's move on to Better. I mean, there's a ton to talk about here. Let's talk about the vision of Better and helping homeowners, because I feel like there's a lot really interesting there. And, talking a lot about, the more I think about it, there's a ton of different problems for homeowners beyond mortgages. So I'd love to hear a little bit more about, that philosophy.
I look at this and I just think this is like an industry that time forgot. One of our investors said this. It was like it was one of the founding partners of Kleiner Perkins, and he said, this is the company that Jeff would have started back in 1995 if he didn't move to Seattle. And I was like, you're totally right. He should have totally started this company. This would be way better. And I would have had no trouble getting a mortgage in 2014. And I wouldn't have had to start this company and life would have been great. Like the past 5 years have been really, 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 really hard. Like I didn't want to start this company. Like I was like an investor. I was like doing perfectly fine, living a nice life, but it's so broken. How do you find a good realtor? How do you know the rate you're getting is a good one? Why does it take 60 days? Why do you get to pay less if you're paying in cash versus in credit? Like this isn't like, that's not how it works everywhere else. Why do I have to like deal with like 2 other people to sell some? Why can I buy, you and I can buy a pen on eBay from each other, right? But we cannot buy a $300,000 house. So like, if no one solved, like people have found a way to like sell you a pen or an app on eBay, but you can't do that on a house. Why does it matter whether I have kids or a dog? You're selling me the house. Why does it matter, what church I belong to? Why do so many things matter when I'm trying to buy a house? And you get to this and you're like, why it matters? Because there are people that are still stuck in the past and they don't want to let go. Yeah. And ultimately, the big thing about the internet is the internet is the great democratizer. It's a democratizer of ideas. It's a democratizer of commerce. But here is this industry that is entirely intermediated by people whose average age is 57 for like an average realtor, 64 for an average mortgage broker. These are people that were, quite frankly, they were born and grew up in a world before the Civil Rights Act. Right. And it's like, and
it's just fascinating to me, right? You see all these different areas being digitized, and I know we spoke to, at FinTech today, we spoke to Alana Noller, who's the head of product at Better, and got to learn so much at the beginning of COVID of just how just antiquated and like manual the process is. Like closing a house, the escrow process is a nightmare, right? Like, looking for a house during COVID, you can't actually go to a house and look at it, right? Especially in LA, right? I'm in LA and like everything shut down here. If I was going to buy anything, there's nothing I could do. So the entire process should be completely digitized, and it's fascinating to hear about that. So that process is already, you guys have been thinking about digitizing the entire vertical process from the start, right?
We've been thinking about how do you make the whole process easier for people to transact so that they can transact with confidence without having to waste well over 100 hours, which even if you're like minimum wage, it's like $1,500 of your time.
Yeah.
Like, and time you don't have, time that you need to put food on the table, time that you need to afford the mortgage, you're spending trying to get a mortgage, right? Yeah. And so why are you doing that? And when ultimately it's just data moving from a page to a computer to a page to a computer to a page to a computer, and that's what machines were created for. That's what technology was created for. It's been solved in other processes like taxes, right?
Yeah.
With like TurboTax. Yeah, maybe 1% of people need to have like a fancy schmancy like Big Four accounting firm do their taxes, right? And maybe another 9% of people need to have like their real accountants. But the bulk of Americans, like, they should be able to get their taxes done for either $49 or free. And so those are the types of things that we ask ourselves, why is this not better? And we're actively taking, steps to digitize it. That's step one, actually.
Yeah.
Some companies are like, oh, we made the digital mortgage. Thank you, done, finished. It's like, no, that's step one. The second is, now that you've digitized it, now you need to automate it. Then you need to have it work for the consumer. Then you have to have it lower the price. Then you have to have it be enabling and empowering. And once you've made it enabling and empowering and actually affected the two pillar stones, affordability, like you've made it much cheaper. So instead of getting a 3% rate, you're getting a 2% rate. So when you can get a 3% rate, you're paying $2,000 a month. When you're getting a 2% rate, you're paying $1,200 a month. When you're getting a 3% rate, you're affording a $300,000 house. When you're getting a 2% rate, you're affording a $550,000 house. That's the difference. And so those are the types of things that we think about: affordability and then accessibility. Like, it's so frustrating that you literally have to really, really, really want it. And then, you know what I'm worried about? The first time I was trying to buy a house, I was like, what if we don't really like it? Like, am I going to pay 6% to sell this house? And am I literally going to give away 1/3 of my down payment to sell this house? We can take a mattress and ship it across the ocean and offer free return shipping. We can ship it across the Pacific Ocean and offer free return shipping. And it cost me 6% to sell a house that I have to like enter into a price war to buy.
Yeah, and I'd love to hear a little bit more about, beyond the mortgage industry. I think I feel like you talked a little bit about this too in the past, like the opportunity to just help homeowners after the purchase too, right?
Yeah, totally. So once you're a homeowner, this is your largest asset.
Yeah.
Right. You can log into Robinhood and trade like 5% of your assets. You can like go to like Betterment and like check your 401k and all that, and yet like they'll suggest all sorts of tax loss harvesting and profit optimization and all this other stuff. And then like actually 67% of all U.S. consumers' wealth is in their homes.
Yeah.
Right. And that's your largest personal financial asset. And I don't know what a kitchen upgrade is going to do to the value of my house.
It's insane.
If I change the faucets on my house, like, I don't know what's going to happen. I have this wood floor and it like creaks a little, and I don't know what type of new wood floor I should get. And like my parents, they have ideas. I'm like, I don't want my house to look like my parents' house, because that's not where we're going.
I totally get it.
So these are things, and our generation, we want answers backed by data and backed by facts that we can understand, because fundamentally what I think the baby boomer generation doesn't get, the banking system doesn't get, the real estate system doesn't get, is that we are children of the credit crisis. We grew up distrusting institutions. So whereas like someone about in their 50s and older, they automatically trust institutions. Our generation,
it's to like distrust, you know,
simply do not trust institutions. You have to demonstrate trust. You have to demonstrate accountability. You have to demonstrate. You have to lead with data, and that's not what any of these people are trying to do.
Yeah.
And so ultimately, like, you know, if there's a way that we can empower and democratize that process, that's super valuable. And honestly, that's why we're doing so well. We are doing north of $3 billion a month of pure, directly originated on the internet with virtually no advertising and through partners mortgages. We're doing we're at like a $36 billion annualized run rate as of last month of originations. That is more than probably most of the other companies in the fintech space created in 2010s combined together.
As someone who studied the fintech space, yeah, I can tell you that they don't have any run rate. Revenue is not really a major metric for them, but it's interesting too, right? Like there's so much potential.
Right? Revenue run rate.
Yeah, and it's crazy because it's like it's a very much expanding pie in my opinion, right? Like I think like, you know, we have a couple more minutes left, and it's like, you know, I think one thing that's really interesting to hear your opinion on is like, how do you think the mortgage industry, you know, goes like, you know, over the next 18 months, and would love to hear a little bit more about how you think things progress in the mortgage industry.
Yeah, no, I think we're just at the really beginning, that like the iceberg's melting and it's going to start melting real fast. Because you have to think about it. What's happening is we have grown up in this time where for the past 10 years, people in our generation were like, I don't think I can ever afford a home. I don't think I ever want to own a home. And then COVID happens. And like all this activity just accelerates into the future. And suddenly you're at your parents' house and you're like, this is not bad. Or you're like living, you know, renting a house and you're like, wait, like I can now own 4,000 square feet for the price of my 400 square feet studio. Right. Yeah. And like, oh, actually, I know I like this person that I'm spending 3 months with, right? Like, you know, it quarantined and stuff. And suddenly, like, it's just moved the future forward. So think about, like, I think there are like 60 million millennial households that are going to become homeowners in the next 5 years. And the current real estate mortgage industrial complex has no way to deal with these people.
Oh, yeah,
and to service those people.
More minutes.
Right.
I'm thinking about buying places. Yep. And it's really interesting, right? You hit it on the head. Like with COVID, we're all stuck here. We need like things like space and actual like home ownership is becoming much more attractive for a really interesting segment of people who've been really not really interested in that. I'm 29 years old, not really, you know, pre-COVID was not really planning on buying a house anytime soon. Now I'm thinking a lot more about like what, you know, how to get there, if that makes sense.
Oh, totally. And the affordability. The average rental yield on an apartment in the United States today is 7%. The average interest rate to buy a home on a Fannie Mae Home Ready First Time Home Buyer program, where you can put in down as little as 3% down, is 3%. So when you're renting, you're just paying your landlord's mortgage plus a profit.
Yeah.
That's what I tell everybody. It's like, should I buy? It was like, how much are you paying rent? How much is the place worth? So you're paying your landlord like 7% interest. Why wouldn't you rather borrow 3% from Fannie Mae and own the house?
All right, cool. Now I have to go to better.com and look for a mortgage, I guess. Great. Thank you for convincing me.
Totally. Go to better.com, find out how much house you can afford, and then get on the path to home ownership, which is the largest wealth creator for average American households that has ever been and ever will be. And own an asset you can understand.
Yeah.
Own an asset you can improve the value of.
And
with your own hard work.
It makes a lot of sense. Well, dude, this is great. Thank you so much for taking the time. Always great chatting with you. Really appreciate it. Hope everyone enjoyed as well.
Ian, thank you.
Talk to you soon. Bye,
Cheers.
everyone.
Bye.